Hey there, welcome to the Reinsurance Podcast, the place where we dive into all things reinsurance, the coolest part of insurance. We're your hosts, Jared and Ben, a couple of ex-practitioners who loved the industry so much we founded Supercede to tackle some of its biggest headaches. And we're here to share our insights and stories with expert guests as we uncover what's really going on in the industry.
Welcome back, everybody, to another episode of the Reinsurance Podcast here in Monaco. Delighted to have with us today Jim Lye, the active underwriter from Antares, who I'm hoping will guide us through much of the noise at this year's conference. How are you, Jim?
Good. Glad to be here, thanks.
Glad to have you on the show. I would love to do a bit of a background on you first, so people understand your expertise and where you come from.
Okay.
How did you get into the industry in the first place?
I got into the industry through a slightly weird route. I was a qualified engineer and I was working on as an expert witness in oil and gas claims, and most of the time we were working for insurance companies, and I thought, well, fun. So
Very cool.
I moved to an insurance company and haven't looked back since.
Nice.
And I've been with Antares for, it'll be 12 years this November.
Very cool, very cool. And you moved up through various bits, energy,
yeah, so
terrorism, all
started
these
in
sorts of
energy,
things.
then we have divisional head structure, so I moved up into that and then took over as active in mid-2020. So
Brilliant.
midway through COVID, taking over a new role.
So you've seen then quite a lot of the sort of more turbulent times and also the good times recently, I suppose.
Yeah, I mean, it's certainly been a good market. I mean, one of our kind of challenges over the last 4 years was actually looking at kind of adequacy of reserves in some of our long-tail casualty lines. So obviously the good underwriting performance of the more recent years has helped to subsidise that reserve strengthening. You know, we've really spent a lot of time looking at the development curves and actually really making sure that we're reserved appropriately, because we want to be in a position where we're actually releasing reserves rather than strengthening them.
Absolutely. Yeah.
So yes, the kind of benign cat experience the last couple of years has really helped with that.
Brilliant. Yeah, well, long may it continue, possibly.
Well, not too long, because then the rates will go down.
Well, yeah, also true, also true. We wait with bated breath to see whether the hurricane season from hell will actually materialise. But and Antares, you're doing all sorts of lines of business, so I suppose.
Yeah, so we are $620 million gross syndicate with about 15 classes of business.
Nice.
Pretty broadly split between, we have marine engine terrorism, specialty, which is kind of like casualty FinPro plus other specialty lines, and then the other third is reinsurance.
Brilliant. So you'll be able to comment on almost all market trends with
most of them, yes.
With that overview. Any standing out to you at the moment?
There's no real one class where we have any real kind of standout issues.
Yep.
I mean, I think, you know, last couple of years, property treaty for us was a really big area of growth and opportunity. You know, with the dislocation in the market in late 2022, we went back to Lloyd's after submitting our business plan, having it approved, and we said, by the way, the market's really changed. If we stay within these vague parameters, would you allow us to potentially increase our premium by up to, you know, another 100%?
Oh wow! Okay.
They gave us, you know, we'd always been quite well performing in that class, but always relatively small. So they gave us a nod to increase it. We actually managed to increase by 175%.
Goodness
oh,
me,
sorry,
that's-
not 100.
Yeah.
We were increased by 75% to 175. But it was still a reasonable jump.
That's just what you want in this kind of market, I guess.
Well, you know, it's all about trying to do decent cycle management. So at this time of year, people sit down, they say, what classes do you want to grow?
Yeah.
And it's very hard to say what classes I want to grow, because if anything is obviously profitable, then I can guarantee that all of my peers in the market are also sitting around saying, well, that's a really profitable class, I want to grow it. And if everybody tries to grow a certain class, then all that happens is people compete more for it and rates go down.
Yeah.
So we are always more concerned with, you know, we have strategies in specific classes, and it's a question of asking underwriters, what income can you achieve with the strategy that you've set out? And trying to give them tools, and also really trying to be nimble and react. You know, if something happens in a market that presents an opportunity, then we can really capitalise on it.
It sounds like you're holding a really nice set of cards, because you've got, you know, 15 lines of business to choose.
It's nice having a lot of levers to pull. Yeah. It's also really helpful to have a good relationship with Lloyd's, where I think in my first year we resubmitted the business plan about 5 times.
Yeah.
And, you know, they're really quite supportive. You know, I know there's often a perception, which I think maybe is in the past, of Lloyd's being kind of somehow difficult to deal with. But, you know, I think as long as, you know, their needs are aligned with ours, they want us to make money, we want to make money. So it's quite nice to have that flexibility to say, look, we see an opportunity here, are you going to support us to do it? And for them to say, yep, that's fine.
Well, it sounds like you're very deserving of their support with recent results, which have been very good, so congratulations there.
Thank you. Yes, the 87% was pretty much bang on plan, which I'm very happy with. I was slightly less happy when I saw that Lloyd's H1 results were spectacular at 83. I mean, that was a phenomenal result. We actually worked with the kind of our, I got some of my finance guys to run the results, pulling out property from the Lloyd's results and pulling out property from ours, because we don't write much in the way of property DNF at all. And if you strip out property, we're pretty much bang in line with the market, which is, it's okay. But it really shows how profitable property has been in the first half of this year.
Yeah, completely. And how do you find it, I guess, being both a seller and presumably a big buyer of reinsurance?
Well, I mean, it's always a question of, it's always good to have both levers, because there's some markets in which it's good to be a buyer and some markets in which it's good to be a seller. Usually they tend to move in kind of the same direction. I think it is always helpful having the ability to flex, that we have, with the number of classes of business we have, our only real constraints are the net risk appetites. Yeah. So we can move that net risk appetite, if the reinsurance is really hard, we can retain more in the reinsurance and then, try to buy a little bit. It's about what we kind of optimise it.
Makes sense. And so when you come to an event like this, with your many portfolios to sort of pull upon, what are the main signals that you're watching for from the market in various pockets? I think
it's always, for us, it's always important. We come to this event mainly as a buyer. Yeah. So we're talking to our core reinsurance partners and we're trying to find out what their pinch points are for next year. Because we try to align our reinsurance purchasing with different people's appetites. We don't want to say you have to support us across every line at every level. It's trying to find out who fits well in different parts of our program. So if some people like certain types of coverage, or if some people are maybe going a little bit cold on some things, it's good for us to know, because it allows us to prepare for the renewals at, starting at 1/1.
Absolutely, you can make a mental note and make sure that you know the support will be forthcoming if you need it.
And it's always good to kind of come out here and just tell people what our general direction of travel is.
Completely.
Obviously this year it's been, direction of travel is more of the same, or same strategy, maybe slightly less income, but very dependent on rates.
It's funny, isn't it, how it does feel like the market has found a very consistent and steady path through quite a it's riskier world. We say it's a riskier world. I mean, you look at the Lloyd's results and look at the percentage of large and catastrophe claims, they are low. That's the reason why the market's made money. It's not because we've all found out how to get the rating right. We have just been lucky in the last couple of years. So it will be interesting to see whether the market resolve remembers that, or whether people just start getting a little bit excited and, then everybody will have a surprise when there's a large loss. Absolutely. And you've been in the Lloyd's market for a long time, and you've been coming here a while, I presume.
No, actually, this is only my second Monte Carlo.
Okay. Exciting.
So taking over as active role in 2020.
Oh, of course.
Obviously, that was COVID. So last year was our first one with kind of the new management team, and it was. I was surprised how interesting it was. You read about the Monte Carlo conference and you think it's a little bit of a jolly, but actually I was really surprised how useful and interesting it's been.
Yeah, really, really good to hear, and hopefully that means we'll see you here next year.
Yes, almost certainly.
As well, but I was going to ask you, just as part of that transition from pre-pandemic to post-pandemic, have you seen the market change much overall? Or
I think, it was amazing that it took a kind of a worldwide pandemic to force Lloyd's underwriters to give up rubber stamps and pen, but I think that has been a huge leap, You remember pre-pandemic there was targets set by Lloyd's to achieve a certain percentage of income placed by PPL and white space, and all of the new ones that have now sprung up. That has been a game changer. I think the next thing there will be actually making sure that those systems plug into underwriter systems, the Blueprint 2 stuff. That will really change the market significantly.
Yeah, I guess, is that something you have to get involved with and oversee?
Yeah, I mean, look, we've already...
blueprints, etc.
Yeah, we've started to... I mean, we're lucky we have our own in-house policy administration system, which actually works really well.
Great.
So we are already kind of setting it up to receive the data in that. And it's always been a source of frustration for me that, you get a piece of business from a client, goes to a broker, they rekey the data, you then send it to 15 markets who then rekey the data, and everything just seems so manual. And we all talk about AI and things like that, and we should just really be focusing on sorting out the data we have.
Couldn't agree more.
Which I know is actually one of your USPs. But
Oh, it's funny, especially when you said all these 15 different players all keying it in their own way as well.
Yes, right? I mean, it's when you come right down to it, there's only a small limited amount of information that really needs to be put into the policy administration system to generate decent statistics. And one of the things that we've really worked on the last few years is building our own in-house data analytics software. It's it's something which is a really good tool for the underwriters now. You know, we have things like live A versus E curves based on the latest actuarial loss projections. So you don't have to wait for quarterly reserving meetings to know whether something's going wrong or going really well. You can actually see it on a live day-to-day basis.
Exciting.
Which, for me, is a really good tool.
Yeah, I mean, does it open up more easily possible futures where you're using external data sources and bringing in class-specific things as well? Or
I mean, it's always the case that we would love to bring in extra data. I mean, the only real external data we bring in at the moment is the LMA triangles, because that's the easiest way of comparing yourself against your peers. You know, you might think you're fantastic, but realise you're actually underperforming the market. So one of our own internal KPIs is whether or not we're outperforming our own market on a gross basis, gross reinsurance. So,
very, very cool. And I must ask, so you've come to your second Monte Carlo. Similar stories to last year in a lot of areas, but a couple of newer topics.
I think
any catching your eye this time around?
I think for us, I mean, last year we had a very specific message, which was that we had restructured our property reinsurance to cover both the syndicate and our company market. This year it's less of a specific message, and it's more looking at, you know, what kind of areas we should be watching out for, what our reinsurers like. I mean, I think the big message at the moment is obviously casualty, you know, and reserving. You know, I touched on it earlier that we've strengthened it a lot, but we don't write huge amounts of casualty. You know, most of our reserve strengthening was in the longer tail lines where you touch on a little bit of bodily injury in the States, but we don't write a USGL book. And I think if we did write the USGL book, I'd be slightly nervous at the moment. Yeah,
I can imagine there are a few around the market sort of feeling the spotlight being shone upon them.
But the thing is, going back to that thing about, you know, cycle management and opportunity, at some point that will be an incredibly painful market in a kind of earned basis, you know, as losses get earned through and reserves get strengthened, but that will then create opportunity. So we're watching
you'll be poised to scale it when the time is right.
Hopefully, yes.
Oh, brilliant. Very exciting. And I have to ask everybody, because it is a big theme. AI skeptic or whatever the opposite of a skeptic is?
Do you know what? I'm one of those typical kind of like enthusiasts who I got someone within our company to develop a solution to a problem that nobody actually had. It was basically taking a PDF slip, and it will feed into Blueprint 2 eventually. We took a PDF slip and got AI to read it, text recognition, pull out the UMR, client name, inception date, expiry date, currencies, limits, all that stuff. And I thought, this is fantastic. It's going to revolutionise all of the underwriters' days. Nobody used it. I'm still trying to push it. But, you know, that AI as a tool for things like that is really, really useful. It's just finding the use cases that are actually helpful and useful.
Yeah, like a pain point that's actually painful.
Yeah, I mean, it's one of those things, you know, it'll take time to get become normalised and then people to work out genuine use cases. So I'm not a skeptic, but I do think it goes back to, you know, we have a lot of basics to get right before we really start looking at AI. I think, you know, the market as a whole has a tendency to look at the new future, like, oh, the grass is going to be greener when this comes in, rather than actually focusing on what you have now. I mean, bordereau data in the market is inconsistent at
leaving
best.
room to be
yes. I mean, we've, you know, where we have our own in-house analytics system, we're starting to ingest bordereau data into that, and in order for you to do that, that bordereau data needs to be in a very consistent, structured format, which in the Lloyd's market at the moment it generally isn't. It's getting there, but it takes a lot of work with the cover holders to make sure that they actually do it properly.
I can imagine if there is to be a further boom in the MGA world, it will at some point need to catch up with its own data.
I mean, in an ideal world, you know, you'd sign up an MGA, the bordereau would come in, and you would automatically get the data in your system. We're a fair way from that.
Absolutely.
But we're trying.
We can look forward to the future, hopefully, and hopefully, you know, maybe
it won't take another worldwide pandemic to make things change again.
Quite. Hopefully, we'll come back to another rendezvous one day, and you'll be telling us all about how it's now happening. And you know.
Well, I've got to say, I do think I would love to see a day where we manage to have risks triaged by AI. You know, I mean, terrorism is a perfect class for it, or probably property DNF, where, you know, the submission flow is so high, and just by looking at it, you probably know, yes, that's worth looking at, no, it's not worth looking at, yes, I've seen it a dozen times. You know, that is a perfect use case for AI. We just need to get there.
And you mentioned terrorism briefly. We had an off-air chat. You helped clarify something for me. New buzzword, SRCC, came up.
Strikes, riots, civil commotion. I think
here and there.
That really raised its head in the South African riots, where I think maybe exposures hadn't been tracked properly, and then also there was a big question about event definitions, where you know, there was a wide range of event definitions across the market, both on an insurance and a reinsurance side. So that really, you know, that data, and upfront data, and then the way in which it flows through the program needs to be looked at. And then obviously Black Lives Matter came in a couple of years later, which again, similar issues. You know, do you treat riots in New York and Chicago as one event, two events? How do you aggregate them?
Yeah.
And then I think if you look at the war, terror, political violence space, pure S&T, which is, you know, things like One World Trade Center, that is the pure, and there's been no losses there.
Yeah.
What there have been is obviously Ukraine war, Sudan war, Israel and Palestine conflict, plus all of the structural right civil commotion. All of this is, you know, raising its head, and it does really focus the attention on diligence and underwriting and exposure management.
And it's a product that I understand has been sold maybe increasingly cheaply in the absence of losses,
I mean,
in partnership with other products as well.
Yeah, I mean, post 9/11, obviously it was a new class, and there weren't many significant losses at all. It seemed almost like a license to print money, so it became very heavily facilitized. You could, with a relatively small team of underwriters, you could sign into very big facilities, and the challenge there is making sure that you keep a good handle on your aggregation data. And we're very lucky we have an underwriter who's an ex-exposure management person, so he's fully aware of how that all works. We also don't really like the facilitized business, especially in the kind of more hairy territories. You know, I'm still very proud of the fact that following the Ukraine conflict, we came out very early on saying these are our risks exposed, and we have not had a single claim on a risk that we didn't already know we were on. Amazing. Which is not something we can say for everybody anyway.
Yeah, no, I can certainly imagine. And I will let you go very soon. It's just very nice having your expertise on all these different moving parts. Marine, perhaps a comment on Baltimore Bridge would be one area, and then maybe to finish, anything you would add to cyber at the moment, obviously having had the strike and everything.
Baltimore Bridge, that is obviously going to be a very challenging claim in terms of actually how long it takes to settle. Obviously the limits on the international group are up to $3 billion. It will be a very difficult, challenging case to settle. But the biggest challenge for reinsurers is actually how to treat it at 1/1. And I think the consensus that I've heard so far is that the market will decide on a number, and they will rate everybody's programs on that number. And then if that number goes up or down in subsequent years, then the rating will change accordingly. And that seems to me to be a pragmatic approach.
Pragmatic,
well, you know, what it means is if you say say if somebody has no loss, somebody says, oh, I don't want to take it into account, but somebody else says, oh, I'm declaring, you know, a worst case scenario. How do you then treat them in subsequent years when it moves? You know, if you just pick one number and that, it seems a pragmatic approach. So let's see if it follows all the way through to 1/1.
Absolutely. And then cyber,
Cyber, I mean, CrowdStrike obviously was a very newsworthy event. If you take the market loss of $1.5 billion, which I think is some of the modelling firms' numbers, take Lloyd's share of that, which may be 20% of the market, it's actually not that big a loss. It's certainly not one that would trouble most syndicates. It's a large loss, but it's not an outsized loss. I think what it does highlight is how different reinsurance structures would respond to the events of that, because obviously it was a non-malicious loss as opposed to a malicious loss. But yes, it was a good reminder of why reinsurance and aggregation on cyber is a challenge. And it's this is the cynic in me. It's almost a shame it wasn't bigger, because I think if it was bigger, it might push for primary underwriters to sublimit named suppliers, unnamed suppliers. You know, like you see in property programs at BI. That currently doesn't really, it's not prevalent in the cyber market. So because you don't have aggregation by, you know, geography or time, you just have aggregation by providers, it becomes a very challenging market to actually really aggregate properly. So it's highlighted the problems, but it's not big enough, I don't think, to really drive change.
So insurance is quite difficult then, actually, is it?
Well, okay, insurance is always difficult. You know, whenever you get it right, then the prices go down. Whenever you get it wrong, you lose money. So it's I don't know why, it's a mug's game, really.
But it's an exciting game all the same, and no better person to steer us through it than yourself. So thank you so much for helping us make sense of it all. This really.
Thanks.
Pleasure, Jim, and we'll see you again next year, I hope.
Hopefully, yes. Thank you very much.
Brilliant.
Cheers.
Thanks for tuning in to the Reinsurance Podcast. If you enjoyed our show, don't forget to subscribe wherever you get your podcasts and leave us a review to let us know how we're doing, preferably 5 stars. For more insights and updates, follow us on LinkedIn and visit our website at supercede.com/podcasts.
You'll find the links in the show notes.